Dame I gospodo, poštovani ekonomisti, poštovani predstavnici medija, dobrodošli u Narodnu.
Welcome to the National Bank of Serbia to the presentation of the November inflation report. Allow me to introduce the colleagues who prepared the report. Vice Governor Bojan Marković, Mr. Branko Hinić, General Manager of the Monetary Analysis and Statistics Department, Snežana Vilaret, Director of the Macroeconomic Analysis Division, Ljiljana Đurđević, Director of the Inflation Report, and Mirko Đukić, Director of the Inflation Projection and Model Development Division. The inflation report will be presented by Vice Governor Marković, and after that you will be able to ask the questions if you're interested in. Thank you, Bojana. Ladies and gentlemen, esteemed members of the press and fellow economists, despite numerous announcements in the media of a wave of price hikes, inflation continued down over the past several months and settled at 8.7% in October. We expect the downward trend to persist and inflation to retreat within the target tolerance band in the first quarter of 2012. At the same time, there has been a substantial increase in pessimism over global growth forecasts, particularly of the euro area. This was the main reason why we revised economic growth forecast for Serbia down to around 2% in 2011 and 1.5% in 2012. In response to subsiding inflationary pressures, the National Bank of Serbia lowered the key policy rate on several occasions during the last 6 months. The key policy rate currently stands at 10%, and its further cautious lowering is likely in the coming period. Today, we will present our view of past macroeconomic developments and our expectations for the period ahead. Mounting distrust in the sustainability of public debt in advanced countries and unfavorable economic growth indicators for the second and third quarters have led to a downward revision of growth forecasts for the global economy and especially for the euro area. The third quarter witnessed a drop in share prices and a rise in interest rates and public debt in a large number of countries. The prices of primary commodities such as oil, global economic recovery will no doubt be slower than expected until recently, and the governments will not be able to respond with fiscal stimuli as they did during the first wave of the crisis, mostly due to high public debt levels. Turbulences in the global financial market induced an increase in Serbia's risk premium, measured by the emerging market bond index, albeit smaller than in the risk premiums of other countries in the region. As a result, the dinar was more stable in this period than the currencies of other East European countries running flexible exchange rate regimes. It is important to note that the National Bank of Serbia did not intervene in the foreign exchange market. Together with high demand for the first issue of the Republic of Serbia's euro bonds, this indicates that Serbia's financial resilience to external shocks of this kind is greater than in the previous years. The stability of the dinar was to a large degree underpinned by the inflow of foreign direct investment, as well as by the conclusion of a precautionary arrangement with the International Monetary Fund. The government's commitment under the arrangement to running a sustainable fiscal policy lessens the risk. It is of paramount importance in light of the forthcoming parliamentary and local elections. In an environment of a global collapse of confidence in public finance sustainability, the perception of Serbia's risk will depend mostly on the sustainability of its budget framework. The slowing of global growth over the previous 2 quarters, and notably that of the euro area, has already reflected in the Serbian economy. According to preliminary estimates, in the third quarter, GDP rose 0.7% year-on-year and fell 0.4% quarter-on-quarter. The fall in economic activity in the third quarter is for its major part attributable to the reduced final consumption of households. As exports and imports increased only modestly in real terms, the contribution of net exports to GDP growth in the third quarter was neutral. Once again, exports failed to record stronger growth due to the drop in exports of base metals occasioned by weaker export demand, especially from the euro area countries. On the side of imports, a decrease was registered for intermediate goods and an increase for equipment and consumer goods. Imports of equipment are the key indicator of an upturn in fixed investment in the third quarter, fixed investment being the only component with an estimated positive contribution to GDP growth. Taking into account downward revisions to growth forecasts for our key trading partners, the National Bank of Serbia revised down its GDP growth projection for Serbia to around 2% in 2011 and around 1.5% in 2012. The National Bank of Serbia's projection is based on the expected stagnant economic activity in the euro area in 2012 and a decline in some of our important export partners. Global growth deceleration, particularly in the EU and CEFTA countries, could feed through to the Serbian economy through several channels. Lower export demand for our products, a decline in direct and portfolio investments, higher interest rates due to rising country risk premium, and more limited access to foreign sources of funding. The channels of impact of the global slowdown on the Serbian economy are covered in more detail in a separate text box in this issue of inflation report. However, let me reiterate, though effects which the MBS has thoroughly analyzed are inevitable, it is encouraging that risk premium movements so far indicate higher financial resilience of Serbia to this kind of external shocks than in earlier years. We estimate that overall in 2011, the greatest contribution to the growth of economic activity will come from investments. Positive contribution is also expected from net exports, while that of final consumption will be negative this year again. Although we anticipate slower investment in the coming year, the effects of investments already underway, notably those in automobile and oil industry, will begin to reflect on the production and export figures only next year. Their impact will, however, be lessened by the weakening global demand, including that of our export partners. Given the still modest growth forecast for the next year, final domestic consumption and by extension imports should also exhibit moderate growth. We wish to underline again that sustainability of economic growth is more important than its pace, which assumes further shifting of sources of growth from domestic demand towards net export demand, with greater contribution of investments within domestic demand.
Inflation has been declining steadily since May this year. The third quarter saw deflation of 0.4%, that is a drop in year-on-year inflation from 12.7% in June to 9.3% in September, consistent with our expectations from the previous inflation report. Consumer prices in the third quarter were pushed down by seasonal decreases of fruit and vegetable prices. A pronounced decline in these prices since April is due to a more abundant fruit and vegetable harvest this year. Processed food prices grew at a slower rate compared to the quarter before, primarily due to a decline in prices of primary agricultural products. In contrast, market-determined non-food product prices grew faster than a quarter earlier, prompted by several substantial seasonal price increases, rather than reflecting a general tendency in movement of these prices. Contrary to the first half of the year, administered prices rose modestly in the third quarter. The only significant increase was recorded for landline telephony services. Overall increase in the year to September, however, at 9.5%, extending beyond the 7 plus-minus 2% framework planned for the whole 2011. According to data published late last week, consumer prices rose in October by 0.4% quarter-on-quarter or 8.7% year-on-year, which indicates continuation of a downward trend in inflation. We expect year-on-year inflation to decline. first quarter of 2012. Disinflation pressures stemming from low aggregate demand will be strong in the coming period, in light of the expected lower growth in economic activity. The falling fruit and vegetable prices over the previous 2 quarters will be factored into year-on-year inflation rates until the next season. However, being currently at a low level, these prices could rise faster than prices, even if the 2012 agricultural season turns out average. A rise in processed food prices will probably be modest in the coming period, given the fall in prices of their inputs, such as wheat and corn, which was primarily due to developments in world markets of these products. A disinflationary effect will also be generated by a decline in world prices of other primary commodities, such as oil and base metals. Furthermore, we expect administered price growth to be slower in 2012 than in this and earlier years, though departure from the planned level, as it has happened so far, is possible. The disinflation process will be further fueled by declining inflation expectations. Though anchored over 6 months, inflation expectations declined from around 8% to around 6.7% in the last 2 months, and we expect this tendency to continue. A fall in year-on-year inflation will be particularly strong until March-April next year as a result of the base effect. Namely, though monthly inflation rates have fallen over the last 6 months to levels consistent with the target, the year-on-year rate remains above the target, as price hikes from late 2010 and early 2011 are still included in its calculation. As these price hikes are taken out of the year-on-year calculation and new lower monthly inflation rates are taken in, year-on-year inflation will decline and return within the target band. The key risks to the presented inflation projection are largely associated with movements in the international environment and fiscal policy at home. World analysts agree in the assessment that global growth will be slower than expected until recently, but there is a large difference across individual forecasts. If, contrary to the currently prevailing expectations, the world economy is swept by a new wave of recession, negative repercussions for the Serbian economy and the disinflationary effects arising from aggregate demand will be more pronounced than envisaged in our projection. As regards developments in the international environment, there is uncertainty regarding risk premium movements which may affect capital flows and exchange rate trends. Movements in risk premium will also be largely affected by further compliance with the budgetary framework. In this regard, conclusion of a precautionary arrangement with the IMF is a step in the right direction as it contributes to macroeconomic stability. If fiscal policy adheres to the planned framework, there will be scope for monetary policy to respond more strongly to the disinflationary impact of slackening economic activity. Over the last 6 months, in line with diminishing inflationary pressures, the National Bank of Serbia has been lowering the key policy rate by a total 2.5 percentage points to its current level of 10%. Based on the inflation projection presented today and its underlying risks, the Executive Board of the National Bank of Serbia judges that a key policy rate is more likely to be lowered further in the coming period rather than raised or kept on hold. The Executive Board confirms this time again its previously expressed confidence that a fall in year-on-year inflation will continue and that its return within the target tolerance band is likely in the first quarter next year. So as to be efficient and to use efficiently our time, I suggest that we limit your questions to 2 questions at most, and these questions should last for around 3 minutes. So we aim to finish this presentation at around 11:30. And I would also like to ask all attendants to present yourselves, so you could tell us your name, surname, and the institution that you come from. Thank you. And you can also use the microphone. Yes? Any questions? So I would like to comply with this limitation. So I would like to limit my questions to 2 questions only, although I had 6 or 7 questions. So first, this has been pronounced in the inflation report. So we have disinflationary tendencies, and we also have the liquidity problem, which is being aggravated. And given the appreciation of the exchange rate, at least since April or May this year, and given the past monetary policy measures applied so far, so you have reduced the key policy rate by 2.5 percentage points. So this measure, this tendency is comprehensible, but I believe that it lags a bit. So it is a bit belated. So what do you think, what Vice Governor thinks about the monetary policy response to the problem of real appreciation of the exchange rate and its impact on movements in exports? And what about the trade-off between the debt repayment, that is the support to debt repayment, and the support to exports? So this is my first question. My second question is as follows. So what is the strategic or projected expectation of the NBS regarding balance of payments, given the drastic change in its composition, which is pronounced here rather explicitly? So do you expect a strong contraction if in capital inflows next year? Thank you, Miladin. So I would like to ask Mr. Branko Hinic or Ms. Vilaret to elaborate more on our projection of current account deficit and our projection of capital inflows for the next year as well. First, I would like to answer your question regarding the monetary policy response. So I would like to remind you that the NBS is probably the first central bank that started the cycle of lowering the key policy rate from the moment when first signs of the crisis emerged in the Eurozone. We are in a slightly different position than other central banks because our rates are a bit higher than a probable neutral level. So we have the scope to respond with monetary policy to disinflationary effects and other challenges ahead of us. So I would like to remind you that most other central banks run key policy rates that are at a very low level, so they don't have sufficient scope for some further relaxation. Agricultural product prices reacted much faster in Serbia because they are more volatile, and other countries face a slump in economic activity and soaring inflation because of the lagged effect of food prices, and therefore we have a bit more room than other countries, and we started reacting in June this year. So we have reduced the key policy rate by 2.5 percentage points, and in line with our transmission mechanism, once we lower the key policy rate, we don't expect immediate effects on economic activity because the maximum effect of lowering in the key policy rate on inflation comes in Serbia within 9 or 12 months. But these cuts that we have implemented over the last 5 months will be effective in early next year. And in this regard, this has been a response of monetary policy, and what we've seen, what is happening with the exchange rate. So we have a much stronger stability of the dinar compared to other currencies. but we reached such stronger stability even in the conditions of these stronger steps of lowering the key policy rate, meaning that we have some other fundamental factors, one of them being certainly the inflow of FDIs from delays and fiat in this period, and the other factor, however, is the macroeconomic sustainability of Serbian fundamentals and the capacity of the Serbian state to issue euro bonds in highly adverse circumstances. In this case, Serbia has shown that it has access to international financial markets, whereas some other countries do not have this access. And all this increases the credibility of not only monetary policy and macroeconomic policy and the sustainability of economic growth in Serbia as well. And this has a large impact on the stability in the FX market and in terms of the stability of the risk premium as well. I would like to ask Mr. Djukic or Ms. Đurđević to give some information, some data on risk premium movements in Serbia. But first, I'd like to answer your second question. Mr. Hinic, please. So the crisis spills over to Serbia through the balance of payments mechanism. So any reduction in the expected growth is based on the fact that we have a reduction in the balance of payment flows. So what is interesting for us in the coming period, especially in terms of 2012, we will have no reduction that happened in the exports aspect. So we expect that in the second half of 2012 we will see an increase in exports in some fields. So I first of all refer to automobile industry and some other accompanying services as well. So in terms of foreign trade, this will have an impact on the exchange rate. So we could expect a reduction in this sense. So the question of the real exchange rate is related to this. We do not claim that the exchange rate does not have an impact on trade volumes, although the effect is a lag one. But this effect is particularly strong in the segment when you have price competition. So when you're competitive in terms of price, in terms of exports, and this will be more important in future. So the impact of the exchange rate will not be dominant on the formation of the export supply. And in the next year, we expect a real increase in exports over 8%. And I have to say that there is some consistency between the National Bank of Serbia and the International Monetary Fund mission here, and what is also important here are sources of financing. So there is no doubt that we could have some effects of confidence on financial inflows, and also a very substantial portion of financial inflows, especially FDIs, has been implemented to a large extent. The typical example is the automobile industry, the oil industry, and so on. So we expect also inflows in the energy sector. So inflows are very high and likely. And in the coming period, there will be no major problems that could bring Serbia into some serious problems in terms of financing of the current account deficit, which will be at the level that was recorded over the previous years in terms of its absolute amount. In terms of risk premium, according to the latest data of yesterday, the EBI for Serbia stands at 513 basis points, and over the last months there has been a tendency for our index to rise slower than other countries in the region. So for a longer time it has been ranging at the levels for Croatia and Hungary. So this is a positive tendency, which explains why there is no depreciation as a result. And in terms of premium risk perception, I would like to add that we are talking about yields on 10-year bonds. So these are costs at which a government can borrow in international financial markets. In case of Italy, it is 7.0%. In case of Slovenia, it is 7.1%. Ireland, 7.9%. Portugal, 7.17%. Serbia, 7.25%. And in terms of the risk perception of Serbia is much lower than in many developed countries and other countries in the region. So this speaks volumes about the current risk perception of Serbia.
You said that we expect stabilization of the exchange rate, also based on inflows from Deleuze. Have we received these inflows? We explained why the exchange rate is stable. Inter alia, the exchange rate is underpinned by FDI inflows, the perception of risk, and foreign direct investment. Most of foreign direct investment includes Fiat and Deleuze. In the first 10 months of the year, foreign direct investment amounted to, I will ask Ms. Neža Velare to give us precise figures. Since the beginning of the year, net FDI inflow, so we monitor movements on daily level. When you include the first 20 days of October, we arrive at the figure of 1.5 billion. In the first 20 days of October, we have noticed also inflows from Deleuze. The National Bank of Serbia cannot give data about individual inflows, but total inflow of FDI is 1.5 billion, which is, let me remind you, in accordance with our projection for the year as a whole. Our projection for the year as a whole was actually 1.5 billion. I have a second question. In 2006, in 2003 and 2008, inflation was below 10%, and in 2000 it was 120%. High interest rates are really high, and we cannot be competitive. So what should actually happen for our market to heal? I think that the temperature, we are running all a higher temperature, 37 degrees Celsius. How can we lower it? Thank you. Inflation targeting as a monetary regime of the National Bank of Serbia has been implemented implicitly since early 2009. So implicit inflation targeting has been implemented as of end 2006 and explicit as of early 2009. You mentioned that in 2003 we had a single-digit inflation. At the time we were running a fixed exchange rate regime, and now the exchange rate regime is flexible. So we have to achieve greater credibility of monetary policy on the one hand, and on the other hand, sustainable growth. This could help us a lot. Let me remind you, Serbia's growth was extremely high until 2008, but this extremely high growth was led by consumption and by capital inflows, and as a result we had a high current account deficit equaling more than 20% of GDP. So this was such developments were the source of crisis, were the cause of crisis, not only in Serbia but also the United Kingdom and the United States. So we have accumulated the sources of growth and shifted from final consumption towards net exports. So this is something that is much more sustainable, and net exports is a sustainable source of growth in economic activity. So sustainable growth will contribute significantly to the credibility of monetary policy as well as fiscal policy, and this will contribute to reducing inflation to single-digit levels. During the period of transition, this is difficult to achieve, certainly more difficult than in the EU. There is a great price disparity between Serbia and the EU, but we hope this will settle. I have two questions. I would kindly ask you to explain. You said that the National Bank of Serbia has reduced its key policy rate, and so did the European Central Bank. Does this mean that Serbian citizens will pay lower monthly loan installments? And the second thing is that UniCredit Group announced that 10 billion euros is being withdrawn, and that it will close down its branches in Southeast Europe. And if this is the case, have you heard about this, and how will the National Bank of Serbia respond if this is the case? Let me first answer your second question. So this bank is really profitable in Serbia. If you want to see where is the greatest motive for closing down the branches, they would probably close down the branches that are not profitable. We heard no announcements so far, and there will be no major changes in this respect when it comes to UniCredit Bank in Serbia. When it comes to your first question, it is true the National Bank of Serbia lowered its key policy rate by 2.5 percentage points, and the ECB lowered it by 0.25%, and this will definitely reflect on the price of loans. When we're talking about the price of loans, the key policy rate is one of the factors which affects the price of loans. In addition to the key policy rate, the price of loans is also influenced by the country risk premium. The riskier the country, the higher the cost of borrowing. And what also influences the cost of borrowing is the creditworthiness of the client itself. So the loan rate, lending rates depend on the key policy rate, on the country risk premium, and the risk of each individual borrower. So the fact that the key policy rates have been lowered does not necessarily mean that interest rates for each individual borrower will be lowered. This just means that there will be some decline in interest rates. So the cost of borrowing in conditions of lower policy rates lead to a lower cost of borrowing. So borrowing for investment will be lower. It should lead to a lower fall in investment and lead to a stabilization in inflation. What I would like to reiterate is that by contrast to the ECB, which has plenty of room for further lowering of the key policy rate, it currently stands at 1.25%. In the case of the National Bank of Serbia, we have more room for lowering the key policy rate, and in this sense, the lowering that we have witnessed in the past 5 months is greater than in the Eurozone, so which means that we have a greater scope for reacting to the challenges that are ahead of us in terms of slower economic growth than other countries. I'm a bit confused by your answer. If UniCredit, for instance, decides to close down its branch in Serbia, because banks in Serbia are independent legal entities. Yes, this is true. So in Serbia there are basically no branches. All banks in Serbia are subsidiaries, so they're independent legal entities that are in no way responsible for the obligations of their parent companies, of their parent banks. So I guess that if somebody wants to sell its share in a subsidiary, we have had no announcements in this respect so far. Gordana Filipovic, Bloomberg. I'm interested in the non-performing loans. You said they amounted to 18.8% in September, and the International Monetary Fund recommended some statutory changes that would enable the lowering of this ratio. So if you could explain how fast you can react and improve the situation. Thank you. Non-performing loans in Serbia, according to the latest data from September, equal 18.8%. I would like to remind you, before I elaborate on your other questions, I would like to remind you of several things. Non-performing loans are always rising when there is a decline in economic activity, and we have had a decline in economic activity in 2009, and the decline was quite steep. In 2010 and 2011 and 2012, we will have slow economic growth, and we expect that non-performing loans are close to their peak. Second important thing is that, by contrast to other countries, in Serbia, the provisions for loan losses amount to 127%. This means that all non-performing loans are covered by the provisions that banks have earmarked. The third very important thing is that when we're talking about the liquidity of the economy, the level of non-performing loans is not that much at stake, but the level of NPLs relative to the pre-crisis period. Now I will ask Ms. Lida Đurđević to give us some more detail and comparable data for other countries. For instance, in order to write down a non-performing loan, you have to wait for the completion of the entire procedure of bankruptcy. So sometimes non-performing loans can stay in your books for 10 years, and this is something that the IMF is currently discussing with the government, and they're trying to find a way how to speed up this procedure and lower the level of NPLs. Structural measures regarding court settlements and tax procedures. I would also like to say that it is not enough to look at the level of non-performing loans, but look at the structure of non-performing loans and the change in their level relative to the pre-crisis period. So we have to see what are actually the root causes of such a high level of non-performing loans. If we compare the latest available data of the International Monetary Fund ending with June this year with the data from 2008, we'll see that a higher growth in the share of non-performing loans was recorded by Bulgaria, 11 percentage points, Romania 10.6 percentage points, Hungary 10.4 percentage points, Slovenia 9.9, Bosnia and Herzegovina. Growth in Serbia in the share of NPLs was 7.4. So we are quite satisfied because the situation is difficult, and the situation in other countries in the region is even more difficult.
Any further questions? Given the level of 18.8% for the Serbian economy, so where is the potential of banks to increase lending activity? What should motivate banks to step up lending? So you have the obligation of the apparent banks, you have high NPLs and capital requirements as well, you have low economic activity, so where will bank find this inspiration to lend? Wherever the profit lies, I suppose. So, on the other hand, I would like to also say that when we think about this level of 18.8%, we have to take into account the share of other factors that have been in place for the last 10 years. So we have these court proceedings as well, and so on. So we have some inheritance here, some inherited factors as well. As for the write-off of such NPLs, it would clarify the situation, and we would have a more exact data information on the level of NPLs. So if this is all, if you have no further questions, so I would like to thank you very much for coming here today and for participating in this session. Thank you.